Now, in order to determine our interest expense on the long-term debt for the projected period, it's going to be equal to, we take the interest rate and we multiply that by the average of the beginning and the ending debt balance for the existing long-term debt for the focus period and the average of the beginning and the ending debt balance on the debt additions that could be made. So we're going to be doing that, taking the average of those two debt balances to account for the total interest expense on the total long-term debt. So in order to do that, we will go to the control panel tab. I will make sure that it's set this year right close to the interest rate year underscore interest rate so we name that cell interest rate. Then we can copy that. Then we go to the top left and we override this by pasting it here to name that cell. So we have that cell up there. So we name that this cell the interest rate so that we can just use that to multiply to use it in our financial statement without flipping back and forth. So we can go to the financial statements here to include that interest rate. So it's going to be equal to, we take that interest rate we multiply that by the average of the beginning and the ending debt balance year existing long-term debt. Then we also have to include the average of the beginning and the ending debt balance for the debt additions. Have that in place, we can close that, and we can also make sure that we are closing this bracket here. Close this, and we close this again, and we can press enter. So for now, it's going to give us a div 0. We can just make sure that we could just have an if error here. So we go to the end and we say if error. Just give us an NA. Close the bracket, press enter here. So we can fill this formula right to the end of the projected period. So since we're going to be needing this interest expense on the long-term debt very soon to fill in our income statement for the projected period, we could just make sure that that's going to be carrying over by the time we go to the financial statements. So let us make the total debt balances or the debt additions to be 0 for now. But when we are done with the debt schedule, when we come back, when we are done with the debt schedule and the funding requirements for Amazon, if there will be any funding shortfall to account for the additions that could be made as a result of that, then we will have that filling in here. So for now, we can fill this all the way to the end of the projected period with Control R. So we have that set up there. So we can also highlight all of these, and we can reduce the decimal places to, I just make that 0 decimal places for the interest. So we have that set up there. So we have the interest expense on the long-term debt calculated here for us. So to account for the total long-term debt, it's going to be equal to the total long-term debt we could just fill this formula right. Since all what we are doing is just summing any long-term debt on the balance sheet, and if there were any current portion of the long-term debt, the accrued expenses, we would have had that also filling in here. So for now, we are done with that, and we are partially done with our debt schedule. So what we want to do next is to go to the financial statement and make sure that all of the line items that we left undone, we could now fill those line items in. So recall that we had certain line items here from the financial statement. Let's just go over them again. For now, we have the operating lease expense, which we calculated a while ago. We also had under the operating leases, so we also have here the interest income, which is going to be based on Amazon's opening cash balance in its bank account. So we're going to be taking the interest will be calculated as a function of the opening cash balance to determine any interest income that will be added into that will be added here. So we're going to be determining that, and also the interest expense, which we calculated a while ago. We also have to be determining. We also have to